Ladies and gentlemen, thank you for standing by and welcome to the Healthscope half-year results. I would now like to hand the conference over to your host today, Mr. Robert Cook. Thank you. Please go ahead.
Thanks to everyone for joining and taking the time to dial in. With me today is Michael Samuels, the CFO, and Anita Healy, GM Investor Relations and Business Development, and also David Ellison and Caroline Sladen. I'd like to walk through the slides and we'll welcome any questions at the end of the presentation. So I'll kick off, and I'm conscious of the time and allowing enough time at the end for questions. So just to sort of touch on the financial highlights for the half. It was a strong first half result with operating EBITDA up 9.1% to $193.2 million. Importantly, we have reaffirmed our prospectus earning forecast of full year EBITDA of 387.3 and an operating EBIT of 284.7 million, and we'll give a bit of clarity on that later on during the presentation. We're seeing revenue growth continue to translate into strong operating EBITDA with a further margin uplift of 50 basis points. The hospitals, which are 80% of our bottom line, continue to be the powerhouse, and EBITDA there increased by 11.1% to 166.1, and again an EBITDA margin uplift of 80 basis points. International pathology continues its strong performance, and again saw excellent EBITDA growth of 17.1%. Australian pathology had an EBITDA decrease, which we'll explain, but it was largely caused by an unexpected Medicare fee cut, which occurred on the 1st of November, and ongoing rent pressures. But it is less than 3% of our business, but obviously occupies more than 3% of our time. Strong cash flow conversion of 99%, and we declare an interim unfranked dividend of 3.3% per share, in line with stated dividend payout ratio of 70% of pro forma NPAT. I'll now turn to the next slide, operational highlights, and just walk you through a bit of detail around these highlights. We sort of talked for some time about our market-leading reputation for quality and clinical outcomes, and I'm confident we have led the industry in repositioning how we measure and publish quality data. Importantly, this is now transforming into health fund negotiations, and I believe it's also important in government tender criteria. So the quality is being linked with a business outcome, and we're very focused on both of those areas. Labour and procurement initiatives continue to deliver efficiencies across the divisions. We've got good, stable management teams that continue to deliver on these key areas at a local level. International pathology is performing strongly across all countries. Importantly, this division now contributes 15% of our EBITDA and provides a great platform for us to look at further expansion into Asia. The hospital expansion projects are progressing well, with 5 major projects under construction and a further 7 major projects approved, which are expected to deliver 463 new beds and 28 operating theatres by the end of FY15. We continue to deliver and focus on the growth potential of our portfolio. We were awarded by the New South Wales State Government the contract to design, build and operate and maintain the new 450-bed Northern Beaches Hospital, scheduled to open in late 2018, and I'll touch on that a little bit later in the presentation. So quickly, a summary of the highlights would be that we have delivered on what we said we would, and we will continue to do so. We have let our actions and our results do the talking. I am optimistic that we have only just begun the journey of realising our growth potential. I'll now hand over to Michael Samuels to take you through the group operating performance.
Thanks, Robert. So I'm now referring to slide 7 in the pack that you've no doubt got access to, and I think a really good solid first half performance. The results are on track to deliver the prospectus earning forecast, And just for clarity there, in the prospectus there's obviously a range of forecast numbers there, and just to clarify that the statutory and pro forma numbers in the prospectus are the same all the way down to EBIT level. And really the only difference from pro forma below EBIT is the fact that the capital structure in July was that of the previous private ownership pre-IPO at the end of July. Therefore, the interest expense is the primary source of difference. But a really solid result for the first half. Revenue of just over 1.2 billion, up 6%, translating to 9.1% EBITDA, operating EBITDA growth at 193.2 mil, and 10.1% operating EBIT growth at 142.9 mil, working its way down to net profit after tax statutory number of $58.6 million for the first half. The results were underpinned by strong performances from hospitals and international pathology, solid revenue growth translating into strong earnings growth. The group operating EBITDA margin is up 50 basis points to 15.7% for the first half. First half earnings per share of 3.7 cents. Strong cash conversion, which is continuing up a trend of 99% of EBITDA. We brought to account $4.9 million of non-operating expenses, which primarily relate to the restructuring and other costs related to the closure of our Queensland pathology business, a decision we made in the first half and was implemented on February the 1st. The other point I just wanted to clarify on the group slide is just tax. If you do the maths there, you'll see that our effective tax rate for the first half was 34%. Ongoing, it will be closer to 30%, the difference being the non-deductibility of some of the interest from the month of July, which relates to the old capital structure of private ownership. I'll move on now to slide 8. Just some details there in terms of pro forma net profit after tax of $82.7 million. Our dividend policy of 70% of net profit after tax is based on the pro forma net profit after tax, the only adjustment being, in essence, the July interest factor combined with the 4.9 mil of operating costs. The value of the dividend is in line with that detailed in the prospectus, and the payment date is March 24. The dividend will be unfranked due to the carry-forward tax losses that the Healthscope Group continues to have. Slide 9, just some headlines from gearing and capital expenditure. At the end of the first half, we had net debt of $837 million. As you can see there, quite a fundamental change from our comparator of FY14 following changing capital structure post-IPO. The debt to EBITDA ratio 2.24 times at half year. Total capex for the first half at $152.4 million. You can see there's a significant ramp up in growth capital expenditure that will continue to ramp up in the second half as we execute the brownfields and relocate and grow programs, which there's more detail a little bit later on in the pack. The other thing I'll just draw to your attention is that we have made an adjustment to share capital under Section 258F of the Corporations Act. Broadly, what that means is we've offset $304 million of accumulated historical accounting losses against share capital, but importantly, there is no impact on net assets, no impact on cash flow, no impact on funding. Practically, what we're doing is tidying up our corporate structure with some legacy issues from the time under private ownership. So, but it doesn't impact any of the trading performance or anything for shareholders. I'll just turn now to walking through briefly the divisional performance. Hospitals on slide 11. Hospitals, remain the engine room of the business with 80% of our EBITDA. A really good solid first half result from hospitals. Revenue of $938.9 mil, up 6.3%, translating to 11.1% EBITDA growth and 166 mil, and 11.6% EBIT growth to 134.3 mil. And importantly, our margin improvement continues with 80 basis points improvement with EBITDA margin up to 17.7%. Importantly, the revenue growth of 6.3% is largely organic growth. There's very limited brownfields impact with only 23 beds opened over the past 18 months, and as I've said to you previously, we're in a major construction phase in the lifespan of Healthscope with a range of important brownfield developments that start to open late FY16 and onwards from there. So our business results are very much an organic business as usual result. And our volume growth continues to be constrained in some of our key sites, the likes of a Knox or a Norwest or National Capital, which really goes to the heart of the brownfield strategy. The labour and procurement initiatives continue to deliver margin improvement. Our direct sourcing pilot's proceeding as planned. We've got 6 major brownfield and relocate projects under construction now, and there's a range of other projects that have been approved, and Robert will talk about those a little bit later in this presentation. And our quality leadership continues. We continue to achieve high market-leading quality and accreditation results. 88% of our hospitals have passed results from accreditation with no follow-up actions, which is compared to an Australian industry average of just 17%. I'll move on now to slide 12, our international pathology business. Again, a really good, strong performance from international pathology, which is now 15% of the group EBITDA. 8.9% revenue growth to 117.6 mil, translating to 17.1% EBITDA growth of 28.6 mil and 170 basis points margin improvement. Strong performances across the board with New Zealand, Singapore and Malaysia all performing well. New Zealand's EBITDA growth was 13.1%. The revenue growth reflects has a benefit of the pro rata impact from the DML business acquisition, which we completed in October 2013, and we continue to work hard there over efficiencies in the lab and workflow management, improving margins. Singapore delivered some solid organic growth with revenue up 6.5% and EBITDA growth up 4.6%. And Malaysia, revenue growth was up 2.9%, but importantly, EBITDA up 26.4%. Just continue to work on cost efficiencies in those operations, and they're good, strong, solid businesses in Southeast Asia. I just turn now to slide 13, Australian pathology, which of course includes medical centres. It'd be fair to say that the Australian pathology market, the industry sector, still remains challenging. We recorded 2.7% revenue growth to 177.2 mil, a slight EBITDA profit reduction to $9.3 million for the first half. I guess in terms of Australian pathology, it's a stable underlying operational performance, but we continue to be impacted by the rent pressures and regulatory changes. The result includes 2 months of the unplanned, unexpected Medicare fee cut, which came into effect from November 1. We continue to be very focused over efficiency improvements, improving margins in our business. We took the decision in the first half to close our loss-making Queensland pathology business and implemented that closure on February the 1st, 2015. Our medical centre business continues to perform well. There's a revenue growth through a combination of increased volume and average fee, and continue to work and progress labour and procurement initiatives through that segment. So with that, I might hand back to Robert to take you through a strategy update.
Yeah, thanks, Michael. So we're on slide 15, and I'll just take you through quickly the strategy update. The good news, it's the same strategy, but we continue to, which is reassuring that our strategy that we set a couple of years ago has remained unchanged and still has a lot of upside from delivering on those strategies. Obviously, occupancy and utilisation continue to be a focus. The overall health market continues favourable demographics, and we continue to leverage from our scale wherever possible. In the brownfields, it obviously remains a key focus in leveraging off our great asset base. I think the hidden story here about our brownfields is that we are in the high growth areas of Sydney and Melbourne with high insurance rates. So obviously we're ring-fenced the Sydney, and obviously Knox and North Park in Melbourne again offer great opportunities for further growth and expansion. The relocate and grow, which we talked about a few years ago, we've actually the Gold Coast private is well and truly up out of the ground and on track for an opening in early 2016. The Holmes Glen project has now been signed, and we look forward to getting on site there in the next month or two and delivering on that one. In terms of government outsourcing, Northern Beaches was a great result. It's a premium location with an innovative PPP-style model for hospitals. We look forward to evaluating more opportunities in the future. International growth. Again, we've been busy looking at what we can do there and our operating model that we are sure is transferable into selected Asian markets. And I look forward in future presentations to articulating some opportunities that we believe will develop in the next few months. I'll now turn to the slides and just walk quickly through the projects that have been completed in the first half of 15. Campbelltown, Newcastle, Sydney Southwest and Pine Rivers in Queensland. And just to reiterate Michael's point, I mean, probably the only the good news is that our results, the business is driving the results that we said. The little bit of frustration is that we did take that 12 months off to develop master plans and plan properly for not stage 1, but what we are sure will be stage 2 and 3 of development of key hospitals like Knox Norwest. So there is just a timing impact, and we made a point during the prospectus that don't get ahead of us on when those beds open, but those beds are on track to be delivered. Yes, really in 12 months' time I'll need to be buying lots of pairs of scissors because I'll be cutting lots of ribbons during 16 and 17. But it will take another 12 months before we see them really kick in. So I just wanted to make sure that those of you who are banking on the upside, you can bank on it, but we must ensure that we're all aligned on the timing impact of that. Projects under construction, I can confirm that all major projects are on track, on budget, and going according to plan. The projects that have been approved by the board, and really it's a further pipeline, is in varying stages of development. Most of them are awaiting permits. Some are a bit more advanced than that, but you'll see there a couple of important ones. Certainly North Park with an emergency department. North Park area in Melbourne, which is sort of Epping, Bundoora area, reminds me of Knox sort of 10, 15 years ago. It has that same feel, and we're sure that the emergency department will drive that hospital from current Tier 2 status to Tier 1 in the longer term. And the other projects there, including Holmesglen, are also equally exciting. Northern Beaches, I think there's a lot already publicly available out there on this project. Just want to sort of summarise by saying it was a fiercely fought, complicated and expensive process. We're very proud to have been selected, and we look forward to operating what we think will be one of Australia's, if not Australia's, premium private-public facility under this new model. Slide 20, international pathology. New Zealand just continues to deliver, and great management team, a real credit to them, and a credit to what they've been able to achieve. We are awaiting a decision on the Wellington District Health Board tender. That's the result of that tender has been delayed. We don't have any clarity on that at this stage, but remain quietly optimistic that we may be selected for that. In Singapore and Malaysia, we are assessing some small acquisition opportunities, but the focus is very much on organic growth at this stage. Australian pathology strategy update. All states are now profitable following the closure of Queensland, and we continue to focus on driving efficiencies. The key to the rebirth of this business lies in the proposed collection centre regulation review, and we remain hopeful that the government will make this happen in 2015. And just a bit of history too. In terms of the business and the history of it, obviously the original Gribbles business gave us large market share in South Australia and Victoria, and we remain very focused on those states. The other states that were all start-up states, Tasmania has been divested, Western Australia divested, Queensland now closed, and New South Wales totally restructured. So, we're back to focusing on where we have scale and how we can make that work. So turning now to the summary on page 23. Just to reiterate, there was a strong result in the first half, primarily driven by hospitals and international pathology, which is 85% of the business. I didn't talk about our medical centre business, which is the results are in the pathology, and that continued to perform to expectations. Really good hospital EBITDA growth of 11.1% and continuing to get margin uplift in that business. And obviously the story here is about the growth and delivering on what we've said that we would do. So in conclusion, the business strategy is unchanged. The business outlook from the prospectus remains on track, and an exciting pipeline for future growth is now materialising. So on that note, I'd really like to thank you for your time and interest, and would welcome any questions from the participants.
Thank you. And as a reminder to our audience, if you do wish to ask a question, you need to press 0 followed by 1 and wait for your name to be announced. Your first question will come from the line of Matthew Pryor from Evans and Partners. Please go ahead.
Thank you. Good morning, Robert and team, and congrats on that result. First question, just in terms of the pressure that we're hearing from some of the private health insurers. Robert, can you give us a sense as to what percentage of the kind of insurer contract base has moved towards this My Healthscope, pay for outcome type contracts?
Yeah, look, we have the two major funds on a pay for quality and one other fund. So we would estimate that 70% of our revenue base has some pay for quality performance metrics tied to it.
Great, thanks. And just a follow-up question in regards to aspirations offshore. Is it specifically in pathology as far as services that you're looking at in Singapore or Malaysia? And can you give us a sense as to what your kind of comfort level is around debt metrics, so we have a sense of how much headroom you have for M&A?
Right. Look, I might answer the first part. It's not just limited to pathology. We are a hospital operator, and we think we've got a really good model and transferable, up to certain Asian countries, and we're looking at a number of opportunities, including more of a management contract focus rather than acquisition. So it's not checkbook diplomacy. We think we have an operating model that is useful to either current facilities or proposed facilities in selected Asian countries, and hopefully we can sort of provide a bit more colour on that in the next 6 or 12 months. And I'll get Michael to talk about our headroom.
Yeah, the only thing I'd add in relation to what Robert said in terms of the opportunities we're looking at up there, they're not capital-hungry opportunities up there. In terms of the general headroom question, one of the subtleties of our senior debt facility is the fact that you'll see the covenant there of debt to EBITDA not more than 3.5 times. The project finance debt that we have in place for Gold Coast and Northern Beaches is not going to get trapped by that metric. So we have quite significant headroom in terms of the banking facility. It's more just a question. It's more of a general question over the balance sheet gearing, and we're quite comfortable that we still have financial capacity to pursue opportunities.
Yeah, thanks, Michael. That was my next question in terms of Northern Beaches and the impact, but you answered it. Thank you.
And your next question will come from the line of Craig Colley from Macquarie. Please go ahead.
Hi, guys. Thanks for taking my questions. The first is on margins, Robert. So very impressive margin expansion domestically. Can you talk about what's driving that? Is it procurement or staffing synergies? Perhaps a bit of colour there would be great.
Yeah, look, you sort of wonder whether we can continue this for 10 years or 20 years, but look, there's a leverage point here. Certainly, we're getting really good labour efficiencies, and it's primarily there's just great variation in work practices. We talk about the business as a whole, but in effect the hospitals operate in 44 very different physical and competitive environments. And so just the sharing of those practices from the amount of recovery time to a whole range of work practices. So we're really seeing competent management teams, deliver around some benchmarking and sharing of best practice. Obviously, the procurement and has been a real focus for us as we do move to more standardised models, and obviously the quality pricing, the focus on that, we are delivering and now being paid for delivering on quality by health funds. And the last one, and probably a key one that we don't talk about enough, is with approximately 70% of our patients on a case paid basis, the management of patients in the best quality clinical setting, but making sure that we operate within the payment parameters that we receive also continues to drive margin improvement. So it's a combination of all those things, and obviously each half, if I gave a breakup, it would look a little bit different. I don't want to go into that detail, but we've got enough levers with enough improvement to continue that, and obviously, when these beds kick in, hopefully we can step it up a little bit more.
Okay, great. And I guess a related question, can you talk to perhaps market inflation in terms of nursing wages and EBAs? I think the commentary around the IPO was that that sort of rate had perhaps flattened over the last few years. You guys expecting a continuation of that, or perhaps a return to the inflation we've seen in the past?
Look, we've got our budget session in April, May, and it'll be a key question state by state. Most of the agreements we have still got sort of 12 to 24 months to run and reflect, more or less reflect rates that public sector nurses have got on a state-by-state basis. So I think we've had 4 or 5 years of stability, low inflation in Australia. Obviously, I am concerned that in Victoria we've got an extra 2 public holidays, maybe, coming up this year, which we didn't budget for. We'll have to work out how to budget for that. So obviously, with a change of governments at a state level, I probably, from a budgeting sense, will be looking at probably 0.5% on a conservative basis, in probably 17, 18, compared to the run rate that we've had, just because the politics of this are likely to flow through to our sector.
Okay, great. And then just lastly, your pathology business now is stable, it's profitable, and you've spoken about, I guess, continued improvements in those businesses. Is there another option? I mean, potentially, could those businesses be looked at in terms of other options for the business?
Oh, look, I think if you look at the actions of this management team with Australian pathology over the last 4 years, it's been an industry that's been really challenged. I mean, I don't think our results. I think the 2 major players in the market are both also reporting similar things to us, that the rent collection issue, what we're paying out is continuing to cause concern. Unexpected fee cuts. So it's an industry that certainly, I hope, has bottomed. Look, I think we've already shown that we're rational portfolio managers, but it's a big part of our business. It is 3% of our bottom line, but it's perhaps 300 mil at the top line, and with 300 mil we should be doing a lot better. So we think we've got to lift our game, but if the industry gets some support, which is long overdue from a federal government, then that'll make our job a bit easier.
Great, that's all from me. Thanks a lot.
Your next question will come from the line of Saul Hadassin from Credit Suisse. Please go ahead.
Thanks and good morning. Just a question, Robert. The insurers over the past couple of days in their results have spoken to this idea of sort of overutilisation or over-servicing driving up hospital volume growth. Just want to get your thoughts on whether you think that's real, and if it is real, how material that is to driving this level of operating this hospital volume growth we're seeing at the moment.
Look, my personal belief is the trend rate that I'm seeing is the same for the last 20 years. I mean, we don't hang a sign out the front saying, if you're not sick, please come in. The referral chain is through a GP, it's through a specialist. Sometimes there may be management practices in the whole industry where there's a bed block trying to get someone into a nursing home. someone does get readmitted, and the funds really focus on the chronic disease, and they're all got various methods and either in-house or call centres and a whole range of activities they're trying to direct members to use. But the underlying features of healthcare, whether it's public or private, remain the same, and that is everyone's getting a bit older, the demographics, the acuity. So I think personally, I think there's a bit of confusion over how a patient arrives at our doors, and also what's happening in Australia generally. I mean, if you get the public health expenditure out and the increase there, I don't think it's much different to what the funds are experiencing.
Okay, great. And just following on from that, I just want to get a sense of when you think Healthscope will be in a position to grow in line with system, if we can believe the FIAC data as being representative of private hospital system growth. The last sort of few halves, you guys have tracked below that, presumably because of capacity constraints. Is this a sort of end fiscal 17 story where you think you'll be back at being able to participate at that industry level of growth?
We've got another 12 months of being 1 or 2% below if you only use FIAC, and just a caveat there, because it doesn't include workers' compensation, motor vehicle accident and DVA. So e.g. our VRC hospital in Melbourne obviously has a pretty significant proportion of workers' comp, etc. So that number, we always sort of challenge it, in terms of absolute accuracy. But without doubt, if you added, 100-200 beds in each half, our growth is going to look very different. So I think what I'm saying is, second half of 16, you'll see some real action, and really, it's after that you will grow above market.
Okay, and final question, either for Michael or yourself. We saw sort of reduction in cost as a percentage of revenue for employee expense and consumables, as you've noted, but there was actually a tick up in occupancy cost and the service cost lines. So I'm just wondering what room you have to try and drive those back down. Thanks.
I think the occupancy cost is largely a Australian pathology marketplace dynamic, that you've got rent costs and collection centres and likes increasing much faster than the top line, which is one of the economic pressures in that sector generally. But in terms of the rest of the cost lines, we're pretty comfortable with where they're at. The pressure points obviously in Australian pathology, and the balance of the business is producing good margin improvement.
Okay, thanks very much, guys.
Thanks.
Your next question will come from the line of Andrew Goodsall from UBS. Please go ahead.
Oh, good morning, and thanks for taking my question. Just, I guess, cycling back to margins, they were a little ahead of our estimates, which is great. But I guess just trying to benchmark against where we expected you to be, I was just going to ask sort of where you are on your sort of ratios for sort of registered nurses, and then also progress on your procurement programs.
Look, I'll talk about the nurses. I'll get Michael to talk about procurement. But the registered nurse ratio is merely one strategy there. We continue to see reductions in agency nursing, and obviously, there's a whole range of issues there. We're on track. We set ourselves an internal target, which we haven't been too public about. But it's basically 1% per year improvement over 5 years in that ratio mix, subject to hospitals and clinical need, and we're certainly on track to deliver that.
And on the consumable side, I think a lot of the benefits you continue to see in our results are what I'll call reasonably conventional procurement activity and discipline amongst the hospitals, and the direct sourcing initiative remains in its fairly early stages. We've got over 100 product lines of high use items in our hospitals right now as part of a trial that's going really well, but the total dollar value of the spend out there in our numbers so far is still very low, but the logistics chain is sorted out, the supplies are out there, and it is a strategy that we can and we will be ramping up. So it's still early days for the direct sourcing side of the strategy.
Sorry, Andrew, I meant to add on the nursing bit, because obviously the mix is one issue, but we also 2 years ago moved to selected university arrangements where we used to sort of take have arrangements with everyone and anyone. We've got 26, which was sort of like a sub-tender. We actually have we used to take 2,000, we now take 3,000 nursing students through our system. In some cases we get paid for assisting in that training, so it's become a little profit line, and more importantly for us is really got us focused on not just training, assisting in the training, but also recruitment pipeline for our nurses. So that's been, again, a bit of a quiet achiever at Healthscope.
Mm-hmm. And my other question just on domestic pathology, obviously seems like Queensland's sorted, but where do you stand on New South Wales? Is that still an underperforming asset, and sort of where's the sort of turnaround opportunity there?
Well, when we, over 12 months ago, we restructured that and basically took, Michael, about 30% off the top line by closure and some very small divestments of regional areas. So it's become, a Sydney-centric pathology business. It actually has surprised me personally on the upside. So, I think each state, each business is a different challenge in pathology. That one at the moment is certainly, surprised on the upside and meeting our expectations following a pretty dramatic restructure over 12 months ago.
Would that still be underperforming relative to the margins you're getting out of Victoria and South Australia?
Well, look, it lacks scale, so you can draw your own conclusions, but we like scale in pathology, so made that. But we just got to respond to the business that we've got, what the ACCC will or won't allow, and also the local market opportunities. So at the moment, that one's not causing me any loss of sleep, but it's still subscale in terms of where pathology would need to be to get premium margins.
Terrific. Thank you very much for your time.
And your next question will come from the line of William Dunlop from BOA. Please go ahead.
Oh, good morning, and thanks for taking my questions. Just firstly, I wanted to know, just around your comment about capacity constraints in Australian hospitals, what areas that's in, and are there any commonalities across sites that you can point to or speak to? Thanks.
Yeah. The comment is in regard to our private hospitals, and the commonality is location. So at Prince of Wales, for instance, we have 180 beds, co-located with 3 significant public hospitals, and we open operating theatres on Saturdays, Sundays, the same at Royal Melbourne Private. So capacity would normally refer to a Monday, Friday environment. In this case, we've even got arrangements for obstetric patients to receive post-hospital care, at a hotel nearby. So we've been really innovative in really pushing the hospitals where we do have 100% occupancy, either in the operating theatre and or bed. So we may be 100% occupied in the operating theatre. So certainly the big ones, and where we're putting the brownfields focus, Knox, Norwest, even John Faulkner in Melbourne, Lady Davison is full, National Capital is full, and it might only be full on 3 days. So each one's got a different profile, but certainly several of our facilities, we unfortunately cannot accept all the admissions or all the doctors who want appointments at those facilities.
Thank you. And a follow-up question on that is where do you think those admissions are heading to, or do you think treatment is just delayed for those patients?
Well, it's a different case. Sometimes it would be delayed, but quite often, the surgeons would have more than one hospital, and they would, obviously take them to, nearby, perhaps smaller or not-for-profit hospitals.
Thank you. And just quickly on the $4.9 million one-off charge you took at the EBITDA line, you've said that most of that relates to Queensland pathology. Is there anything else in there that we should be aware of?
There's a small amount of that relating to Northern Beaches hospital tender costs, but the very large majority of it relates to redundancies and lease tails resulting from the closure of the Queensland pathology business.
Okay, thank you very much.
Your next question will come from the line of David Stanton from CLSA. Please go ahead.
Thanks very much. I wonder if you could run us through the seasonality that you expect in your, particularly your Australian hospitals business, please. Thank you.
Yeah, so I think there's not a material difference between the first and second half in hospitals. You know, it's anything from 50-50 to 49-51 type thing. It really, if you look at our historical seasonality, it's largely influenced by when beds have opened for brownfield developments, if you go back a couple of years. But I think when you look at our half-year result this year, we're saying to you pretty clear that we think that's online to deliver the prospectus number, and it's largely an organic business in FY15.
Thank you. And perhaps to ask a question that's already been asked in another way, you had 70 basis points EBIT increase in Australian hospitals. Can you sort of give us a percentage of how much of that was labour and how much was procurement in your view?
Look, I can't give you specific numbers because I think what I'd say is the strategies of case mix management, labour and procurement run into each other in terms of just general operating efficiency across the hospital group. So I don't have the componentry out there for all that.
We do have local metrics at each hospitals which we judge them on, but you know, at a group level it becomes less meaningful.
Fair enough. My final question is, can you explain, and apologies if you answered this, I had to get on the call a bit late, but I note on page 7 your cash conversion has fallen from on PCP to 98.9. Can you give some commentary around that, please? Yeah,
I think, Dave, the rule of thumb will be that cash conversion runs at about 100% of EBITDA, and we'll get the occasional swing, which basically reflects the timing of receipt primarily of a health fund payment as at the balance date. It's nothing more than that. It's a cash flow timing issue, but there's no change in trend.
Fair enough. So the PCP was perhaps a little high?
Yes.
Thank you. Thanks, guys.
Your next question will come from the line of Bruce Day from CommBank. Please go ahead.
Oh, hi guys. I just had a question, first one on CapEx. So your second half, based on your full year guidance, implies about 280 mil CapEx spend. Is that really just a timing issue around the ramp up of brownfields, or are you seeing sort of any trends around construction costs which might cause that to come in ahead of expectations?
Yeah, so partly just timing of spend. We've had a couple of building contracts that have come in, tendered out for less than our business case assumption. And the one project that we had hoped to have builders on site for now that aren't there is John Faulkner, where we got a delay with Moreland Council in securing the development application. So, our CapEx spend assumes that one was in progress, but it hasn't actually, the major works haven't started yet. We continue to navigate our way through that one. So I think importantly, the brownfield strategy is unchanged and the pipeline remains strong, but the timing issues of some of those spends has changed slightly.
Okay, great. And the second, and the second one was just around the New Zealand, the Wellington contract, sort of roughly up, sort of like the annual revenue opportunity to be about sort of $30-40 million New Zealand. Is that sort of in the right ballpark if you were to win that contract?
Obviously we've got some confidentiality on that, but that would be at the lower end of the range, a little bit higher than that.
Okay, great, thanks.
Your next question will come from the line of Ian Abbott from Goldman Sachs. Please go ahead.
Oh, yes, good morning. Thanks for taking my questions. The first one related to procurement. Just with the fall in the Australian dollar, I notice your procurement costs are still very much within the range of what they were last period, but just how does that impact you, if at all?
Not material, and we've basically got pricing in place with suppliers that are locked down under contract, and we haven't seen any material impact at all coming through from suppliers as a result of the Aussie dollar change.
And do you mainly contract in Aussie or in foreign currency?
Aussie.
Okay, and then my second question related to around borrowing costs, just with interest rates coming down. I'm just wondering if you could remind us when when your hedging rolls off, so that you might be able to participate further in the reductions. Yeah,
so we don't have any hedging on our senior debt facility, so we are enjoying the slide in the risk-free rate. We do have some hedging in place for the Gold Coast project finance facility. So the large interest spend is not subject to hedging, so the benefit will be coming through.
Well, that's great. Thank you.
And at this time, there appears to be no further questions from the phones.
Thanks very much, everyone, for taking time, and we look forward to catching up with many of you in the next week or two.
Ladies and gentlemen, that does conclude our call for today. Thank you all for participating. You may now disconnect.